Welcome to the Jonathan Van Bilsen Show, featuring lively, in-depth conversation with compelling guests from our community. And here is our host, Jonathan Van Bilsen.
Hello and welcome to the show. My guest today is Michael Connon, a financial advisor who's going to share some of the key points on how best to plan for retirement. We'll get into AI and Bitcoin and everything in between. We'll be right back after these messages with the story behind the person.
Top care with top stylists. Book your next hair appointment with Port Perry's award-winning hair salon, Rosario Greco Styles. The hair experience you deserve. Book today. Call 905-985-0099.
Not all Canadians have the time or desire to manage their finances. That's where we come in, helping Canadian families plan for a secure, happy, and successful future. Visit our website at www.teamfg.ca.
Welcome back. As I mentioned, my guest today is Michael Connon. He is the Senior Advisor for the TMFG, the McClelland Financial Group, which is part of Assante Capital Management. Mike, welcome back to the show.
Thank you very much, John.
You were here about, I think it was just before COVID, about four years ago?
Yeah, it was an odd time. I remember there was a lot of masks involved.
There was a lot of masks, and I think we were the only two in the studio.
Yep.
How times have changed. Wow. It's hard to believe that's been that long, actually, isn't it?
It was funny, I drove by a schoolyard yesterday, and it was just full of kids running around, and it was just packed, and it was such a good feeling,
Yeah.
My kids were at the stage where they went right in the middle of school during that COVID time, and there was no soccer, there was no sports, there was no anything, and it was so nice seeing a schoolyard full of kids playing soccer and doing things.
Yeah, I mean, things are back to normal, although they're not the same as they were before, that's for sure.
Yeah.
And which is a good segue into the financial end of things.
Yeah, it's been quite a ride over the last 3 years.
We'll talk about obviously. I wanted to kind of hit on retirement income, seniors, and finances, and that, because if you're working for a living, you've got money coming in, you can do a lot more. But if you're on a fixed income, you don't have that luxury.
Yeah,
so,
it's a big change for people. We often talk about that, and for years we've had something called a client advisory board, and I like to hear what clients have to say.
Right.
And one time I talked about retirement, and people were having trouble with retirement because when you work, someone else is paying your expenses.
Exactly.
And all of a sudden when you stop work, you're paying your expenses.
Yep.
So it used to be someone else's problem, all of a sudden it becomes your problem.
Yeah.
And it's a real tough thing to get your mind around, to actually be using your own money to pay for your lifestyle. And it's a hump.
I think the biggest thing is that you've got that constant money coming in, but when you're retired, you have money, but whatever you spend goes out of the big pot. And I know of people who have run out of money, and it's a scary, scary thing.
All of a sudden, markets really matter once you're in retirement, because that's where your income's coming from.
Yeah. I mean, I'm a big proponent of having a financial advisor as compared to doing it yourself, because with a financial advisor, you have someone who can look after things, who knows what they're doing. So, and hence the reason for you being on the show. I wanted to back it up a bit, though. So you're an Irish kid from New Jersey, made your way to Toronto.
Yeah.
Because I can still hear a bit of that Irish New Jersey twang in your voice.
Yep.
But, you worked with your father, who was a builder, right?
My dad was a builder, and it was interesting where I ended up in the financial industry.
Mm-hmm.
My dad used to, it's funny, it seems like a common thing now, he used to flip houses.
Okay.
Which everyone does now, but this was back in the 1980s. And I always remember him buying this one house, and he would always be very open and explain things to me. And at that time, it was about 1983 or 1984. And he bought this house, and he bought it for $40,000.
Right.
And he went and he had me work on it because he wanted to teach me a trade. And I would have to go and repair all the windows and do the floors. And I learned everything about how to do every type of construction work while doing this. And then he went to go and sell the house. And I remember him selling it, and after all this work, he had a great time for real estate. He sold it for $80,000.
Wow.
Which was great. But after that, he said, well, the guy wanted to take back a mortgage with me, the buyer, and it's at 20%.
Holy mackerel.
So on this, we're at $80,000 at 20%.
Yeah.
So again, when we looked at the money we're getting back, within the first couple of years, you covered off the principal that you paid for the place.
Right.
And it was funny. I realized how hard the work was to fix up the house and how easy it was to handle a mortgage.
Right.
And it seemed the financial world seemed a lot more attractive than the construction world at the time.
Yeah, I'm all about sitting behind a desk rather than using a hammer kind of thing.
Although construction seems pretty attractive right now at the prices you pay. So.
It does, absolutely. So you went to Western University.
Yep.
And you got a Bachelor of Science in Mathematics. I don't know anybody who loves mathematics.
Yeah, I'm an applied mathematician, which basically looks at mathematical models. And at the time, I didn't realize it'd be I didn't know I was going to go into finance, to be quite honest.
Right.
But as I found advanced in it, I found it was very useful in the economic and financial planning side of things.
What were you planning? What were you thinking of doing for a living?
I didn't know. Like originally, I was thinking of being in construction. I was going to go to engineering. My dad was in construction. My uncle had a steel business, so I was thinking about going that way. But I got a bit of a taste of the financial business and liked it. I just found it very interesting.
And then, like most university students, you graduated and went and worked in a bar.
That was it. It was the early 1990s, and there wasn't a whole lot of prosperous jobs available at that time, let's say.
And the bar went out of business, but you met somebody, right, who introduced you to finance.
Bar went out of business, and one of the regular companies, it was funny because I had ended up running the bar at the end of the day, and we had a regular that was in the bar, and I wanted to tell him because I didn't want him coming the next day when the bar was wasn't there. And I said, listen, tomorrow you better go somewhere else because we're going to claim bankruptcy tonight because there was just lack of customers and it wasn't working. And he said, well, who did the bankruptcy? He said, well, I did. So I was meeting with the landlords, I was meeting with the banks and doing all this. And I was only 21 years old at the time.
Right.
And he said, well, he handed me a card and said, come see me tomorrow. And I put it through the bankruptcy at that night, and the next day I went up and went to go see him, and he hired me. And that was the start of my financial career.
And then you met Rob McClelland?
Yeah, and I actually, believe it or not, I met Rob in a bar. That's when he was starting the business. He was actually, we were both bartending to start, and Rob had already established a financial company, and he came and asked me to join him. And it's been a great partnership for
So you've been partners for, I was going to say, it's been 30 years?
Yeah.
My goodness. Wow, how time goes quite quick. And you folks have done well. You've won a lot of awards. You're the top 50. You're in the top 50, right?
So we've been up there for quite a while.
But you're like number 3 or 4 in the top 50,
we usually we've always stayed in the top 50. It goes up and down each year, they make different judgments on where people stand. But
that says a lot. I mean, I have no idea how many financial companies there are in Canada, but I'm sure there's a lot.
Yeah, I think it's the consistency that's important to manage to stay up in that area.
Right. Why would I go to a financial advisor instead of using like a robo advisor?
Everything works well when things are doing well.
Okay.
And, everyone's a genius during up markets because it's very easy. In the last year, we've seen, U.S. markets up by 30 to 35%.
Right.
It's very easy to make money at those times. It's very difficult to know what to do when things go down. And that's, Warren Buffett always said, when the tide goes out, you see who's swimming naked, and that was a great. I thought it was a great thing to say. Everyone does well when the market's doing great.
Yeah.
It's not only about the finance too. It's about the change in government rules. We had a lot of change in taxation laws this year. We had change in capital gain rates for higher capital gains. We had corporate changes, and all these things you need to keep up on. And to do that, it's a full-time job for me. If you have a full-time job, I don't know how you're going to do both jobs well.
Right. Remember a long, long time ago, I was really excited because I was making, I think, 3% on a GIC, and then I found out that inflation was 3.5%. So I was really losing money.
Yeah, this has been a great example of where we've seen a lot of mistakes in the last year. We had the inflationary situation, and all of a sudden, about a year ago, GIC rates finally fired up, right? And everyone got excited, and most people managed themselves because they saw a 5% GIC. Everyone said if you get a 5% GIC, because we're in that 1% world for a long period of time, for a decade. And once you saw that 5%, lock in for that, it's safe. But the equity markets had a 30% year. If you look at the last 12 months, I don't know when it's rare, but this is in the last year, we've seen huge gains in the equity markets.
Right.
And the problem with the GIC, you feel comfortable because you had that 5%, but you really missed out on 25% of potential.
Right.
And that's probably not going to happen for a long time again.
Right. There's, and you bring up a point between equity and bond or fixed income. I assume that people should have a good mix between equity and fixed, but what exactly is equity? Is that the markets?
So equity is basically stocks. So it's companies. Stocks is a term I don't love. If you think of as companies.
Okay.
So an equity is a company.
Right.
A bond is a loan. Right?
Okay.
So if you think of that way, you're either going to buy a company or loan a company money.
Okay.
The problem with, it's not even a problem. Fixed income is exactly what it is. Fixed income is a bond.
Right.
And it's going to have a fixed income. They're very safe in most cases if you buy very high quality companies or government bonds.
Right.
But you have a set interest rate that you're settling with.
So you're not going to get rich on having
You're not going to get
bonds.
rich on that. When you own equity, you're going to enjoy all the ups and downs of that company.
Right.
And the good thing about equities, people always, the big concern right now is inflation. Right? Inflation is, and everyone says, well, how do I protect myself against inflation? And people ran out to buy fixed income because they thought, okay, well, when inflation goes up, fixed income goes up.
Right.
The problem with that is that if you think about it, what inflation is, it's the spending of more money.
Okay.
And if we take a typical example, if you think of, I'll just use an example, Walmart, because a lot of people do shop at Walmart. So when you spend more, when inflation happens, you're going to spend more every week.
Right.
And where are you spending the extra money? In Walmart.
Walmart.
So
exactly.
the best way to fight inflation is own Walmart
Right.
because their revenues are going to go up.
That makes sense. So that's why Amazon did well in that. So why would I even want bond? Why wouldn't I just buy all Amazon stock?
The problem is things do go wrong.
You think?
Yeah, at time, and I can get one thing I can't guarantee, but I can guarantee eventually things are going to pull back.
Yeah.
And when they do pull back, you need some safety in your portfolio.
Right.
Maybe not if you're 20 years old or 30 years old, but if you're coming into retirement, what we saw in 2007, 2008, and 2001, 2002. People cannot retire on a set income and have that much volatility in the marketplace.
That makes sense.
Because they can't wait. They have to take the money out.
So those Northern Tel stocks that I have.
Yeah.
Yeah, exactly. So the idea then is to continually balance your portfolio, right?
Yeah, there's a rebalance. And so rebalance is when you have a set asset mix. So let's say you're going to have a portfolio that's 70% equities and 30% fixed income.
Right.
We went through a great market, right? And all of a sudden, your equity portion is sitting at 80% now, and your fixed income is 20% because they've grown a lot higher. If you keep on leaving that forever, it will become an all-equity portfolio.
Okay, which is not good.
And the problem is you're getting older, too.
Yeah.
Right?
Yeah.
So, not you particularly, but
I am,
people,
but that's okay.
people in general will be getting older. So as people get older, you don't want to go into a more aggressive position. So you need to rebalance that.
Right.
Hence the idea of when things do better, the market is all very cyclical. It's going to go through cycles.
Okay.
So you need a system. Everyone says on the marketplace you should buy low and sell high.
Right.
That's a big thing we say. But you need a system to do that.
Right.
And when you have rebalancing, when something goes up and becomes a higher portion of the portfolio, it would generally be the high part of the cycle.
Okay.
So what you're going to do is sell out those profits, and you're going to move to something that's in the low part of the cycle.
So you keep pouring it into.
Yeah, and it's counterintuitive because people always want to stick with. People naturally think that things are going to continue forever.
Of course. Yeah.
Unfortunately, they don't.
You mean they don't?
No.
I'm going to hold you on that. We're going to take a commercial break. When we come back, we're going to talk a little bit more about that because it's very interesting, especially when you're a senior looking to retire, sort of thing. So stay with us. We'll be back right after these messages.
Pet Value has a fleet of services to help you and your pets to live their very best lives. Visit Pet Value in Port Perry to discover a world of expertise, friendly staff, and everything you need for your pets. Pet Value, your pet, your store.
Organizing an event, promoting your business, or just need to get noticed? At PP Print, our sale flags, lawn signs, and car branding will get you the attention you need. PP Print, more than just printing.
At Voss, your independent grocer, it's all about hometown living and shopping. Owned and operated by Terry and Christine Voss, their newly renovated Port Perry store carries many local items to support our town and its residents.
Welcome back. My guest today is the Senior Financial Advisor for Assante Capital Management, Mr. Mike Connon. Mike? So before the break, we had some interesting conversations about different types of investments, equity, bonds, and so forth. I wanted to touch on the recent election in the U.S. You may recall. There was I guess there was so much controversy about the president-elect. So you'd think the markets would take a big dive, but they didn't. And why would that be?
It's all about consistency. And people want to know where things are going. When there's indecisiveness and they don't know who's going to be in charge, people are really afraid to make a decision. So whether it's good or bad, whether you agree with it or don't agree with it, as soon as you have a direction, people can now look and see where the future is most likely going to go. So uncertainty is just the enemy of markets. And but this year it's hard to say because markets were extremely strong during that uncertainty. Right. It's weird. I was just reading a stat, and there was 10 major elections in the last few months in countries. In each case, the incumbent leader got removed.
Really?
Yeah.
Interesting. That tells you something.
So it's more of a vote. Democracy is a great thing, but it's people basically expressing their independent views to what's everyone's after their own self-interest.
Right.
And inflation has been a problem.
Of course.
And it's a worldwide problem.
Yep.
And maybe the leaders are responsible, maybe they're not.
Yeah. But a change is going to fix things.
The change is going to fix things from what people think.
Yep.
I tend to think there's not much you could do about COVID was inflationary.
Yep.
And everyone, otherwise, there's no country that avoided the inflationary situation.
Right.
So basically, that's what we saw, a vote against inflation to try to change things in the hope that it's going to fix that.
It does seem that the world is kind of going from the left to the right side of things.
Yeah.
And which is it's interesting. I'm not going to comment either way. But I did want to point out the President-elect Donald Trump, you have a connection with him, right?
Yeah,
indirectly.
It was funny. My sister, she passed away many years ago, but when I was young, I was growing up, and as I said, I grew up in New Jersey, and my sister worked for a station when she was about 21 years old. It was called WPIX. It was Channel 11 in New York. And one day she got told by her boss she had to go and take out Benny Hill. They ran the Benny Hill show.
I remember Benny Hill. Wow.
So him and his partner came in, and they were supposed to set up a meeting with someone important.
Right.
And they all of a sudden said, we're going to have you go to lunch with Donald Trump.
Right.
And of course, this was during the 80s, and Donald Trump was the famous bachelor at that time. And
right.
My sister came home so excited because she got to have a lunch with Donald Trump. And she said afterwards, I asked her about it, and I was only 12 or 13 at the time, but when I asked her about it, she said, Benny Hill and his friend were far more entertaining than Trump at the time. But it was an interesting story where she got to meet him and do that.
That's amazing.
Yeah.
That is amazing. I'm not going to comment on who's funnier now.
Yeah.
We'll let that one go. But it is interesting, and you being American, I'm sure it has the election has some roots. As far as the future of Canada now financially, how will that affect us, do you think?
Free trade is something that everyone worries about because last time Trump got in, one of his campaign promises is always to renegotiate the free trade agreements.
Right.
Last time I think Canada came out okay during that type of negotiation. We'll hope the same thing happens again.
Okay.
But yeah, it adds risk to a lot of things. 70% of our exports go to the U.S.
Right.
So it's a big deal.
Absolutely. And it could be a problem. Speaking of the government now, through COVID, the government just threw money at everybody. I get that. Now, for some strange reason, people don't realize we have to pay that back. So somewhere that money's got to come from.
People really caught on to that.
Yeah.
Free money is...
I know. Free still doesn't exist. So what has the government, and primarily on a federal level, I guess, done to help Canadians get through inflation? Or are they part of the cause?
It's a mixed thing, right? The control that they have is generally interest rates.
Okay.
So and some of us argue on the side of they should have started raising interest rates earlier, which may have been a partial cause on inflation. Right. When markets were doing well after COVID, they kept interest rates, I'm going to call it artificially low, for an extended period of time, which let inflation run away on them.
Okay.
And then when inflation ran away, they have to do a knee-jerk reaction and start jumping interest rates very quickly to slow it down.
Right.
So the problem with everything you do with interest rates, there's a lag time.
Right, of course.
And the lag, and everyone thinks it's 1 or 2 or 3 months. It's a year to 2 years before you actually see the results. These interest rates are going up, but people would fix mortgages for the next 5 years.
Yep.
They're still going to have these mortgages coming up for renewals. So that has a long-term effect on things.
Right.
So the government's been doing what they can. I guess you can always argue they were a bit too quick on, or a bit too slow on raising interest rates, and maybe not quick enough on lowering them, or maybe it's at the right side. They seem to be doing a reasonable job in Canada right now with interest rates. I do think they were slow in raising them, but they seem to be doing a relatively good job on cutting them at a reasonable basis.
I'm always shocked because I know the government is quite a bit in debt.
Yeah.
And I'm sure they pay interest on that debt.
Yep.
So the lower the rate, the better it is for them, right?
Yeah, it's not good for the government to have to pay out at 6-7% interest rates.
No, and it translates into being bad for us.
Yep.
Because we're paying for that.
Yep.
But what, you said 70% of our trade goes to the U.S. With the U.S., if the interest rate is different in Canada than it is in the U.S., if it's higher, doesn't that cost us money?
So there's a balancing act. So Canada, we like to think of ourselves as our own entity, but really we are a nation that works under the U.S. because we have so much trade partnership with them. You have to keep your interest rates relatively in line with what the U.S. is doing.
Okay.
If you don't, you'll have a currency situation. So if you keep on lowering interest rates, so you can lower interest rates as much as you want, but all of a sudden the Canadian dollar is going to drop with it.
Right.
And if the Canadian dollar drops with it, because we do import a lot of goods, it's going to be inflationary again.
Right.
So it's a catch-22 situation. You know. So
yeah, interesting. I guess there's no real solution for that. If there was, it would be.
It's a balancing act, like everything else.
Yeah, but then things like the carbon tax and the recent hike in interest in taxes for selling your house, your second property, and so forth. Capital gains. It doesn't help, does it?
Doesn't help. There was better ways that could have been handled.
Right.
You got to understand they do have to get this money from somewhere, so we can't say, okay, we're just going to ignore the debt. So there are ways to deal with it. They could have got equal amounts or better money by handling it in a different manner.
Right. But they're giving it all back now.
Yeah.
so it's a good wash. So let's talk about retirement for a second. So there is a rule of thumb that I learned a long time ago about 4% of your invested income. You should not take out more than 4% of your invested income along with your pensions and stuff in retirement.
And that's just that's a rule of thumb.
Right.
And that was a rule of thumb for someone 65.
Okay.
And it's not that your investment's going to make 4%. What everyone forgets is you got to leave room for inflation.
Right.
So 4%, plus you need, let's say you have 3% inflation.
Right.
So to maintain that 4%, you need about a 7% rate of return, because if you need $50,000 this year, you're probably going to need $52,000 next year and $54,000 the year after. So you need to go and have, beyond what you take out, you need to expect your cost of living to go up.
Because if you don't, you're going to run out of money.
You're going to run out of money because inflation will. Like if you think about yourself 30 years ago, and you thought, wow, if I have $1 million, I would never have to think about anything in the world, right?
Absolutely.
And now people have they have $1 million and they're pretty concerned about going into retirement. So things change over time. So inflation is important.
If I understand that correctly, so if I have a pension, let's say I have a pension of $50,000, and then I've got another government pension on top of that of another $15,000, so I'm now at $65,000, and I've got $1 million invested. If I take 4% of that million as $40,000, then I've got an income of $105,000, which I can live on as long as I don't take more. So if I decide I'm going to buy a Lamborghini and I'm going to take $250,000 out of my savings, that's going to affect the length of my money. So the key is to make sure you stick to that 4 or 5% depending on your age.
And as age goes up, once people hit 75, you might be able to slip up to 5.
Okay.
And it all depends on what you want to leave behind too.
Right.
So for some people who are so concerned about what they're going to leave for their family, you can take less.
Yeah.
So it's all individual.
I mean, it used to be a lot more about leaving behind. Now it's a lot about having enough when you're still around, because people are living longer, right?
Yeah, and the other thing is people, because of all the problems we were talking about with inflation and housing costs and that, people are helping out their kids with big amounts. The amount that people had to give to the kids to help with the down payments.
Right.
I can't remember the numbers now, but it used to go from 25 to now it's around 100,000.
Wow.
People have to gift.
Wow.
To get kids started.
Yeah, I wish my parents had heard of that. So there's an old thing about people not using an advisor, but people making mistakes, but they don't know what mistakes they make. Right. So what are some of the biggest mistakes that people make in the investment industry?
A lot of people, number one is their portfolio mix.
Okay.
They don't look at they don't consider what type of ups and downs they can, they look more at just returns.
Okay.
And they focus on what things have done in the past.
Okay.
Every time you buy a mutual fund, the first thing it says, past returns are no indication of future performance.
Right.
No one understands that.
Yeah.
And they just look at the past and they try to go and take those results, push them in the future. And it's that idea that we talked about earlier. They always buy high. Because if you buy whatever did, it'd be so easy if you could just buy what did best last year and just pick it's going to do best next year. That's not the case.
Right. I can see that being an issue. I mean, it's like anything, right? I wouldn't attempt to fix my own car because I just don't know enough about it.
Another thing, taxes are very high in our country, and if you don't know all the rules and how to minimize your tax, we pay enough tax through what we have to pay without making mistakes on your tax returns and making mistakes on how your investments are lined up and making mistakes on what type of vehicles you're invested into.
We've got a few seconds left. So you're suggesting I should buy Bitcoin?
I was just at a conference and with some of the top minds in the world, and it was interesting. They compared Bitcoin to the Beanie Babies of the 90s.
Oh my gosh, I remember them.
And it was interesting because it said, Beanie Babies were based on scarcity.
Right.
And not Bitcoin, but cryptocurrency in total is based on the idea of scarcity.
Right.
And people try to compare it to gold, but gold is scarce. You can't just invent new gold.
Right.
With these cryptocurrencies, there's just thousands of cryptocurrencies being there and being new ones coming up every day.
Yeah.
So there's really not a scarcity. So that's our true problem with them.
Right. So you can keep adding to it, Mike. Unfortunately, our time is up. It's been a pleasure. I've learned a lot. Thank you so much for being part of our show.
Thank you, John.
And thank you all for watching. Please join us every month right here for the story behind the person.
Want to know what's happening in Skewgog? News and lifestyle, changes in business, and all the entertainment information you'll ever need. Plus, each edition has a new photos and travel article. Look for your next copy in your mailbox.
Whether it's need to know information, local politics, charity fundraisers, or simply fun community events, we have you covered year-round. We are the Standard newspaper,